already dealing with zero-rated supplies, and manufacturers are already in perpetual refund position, many of them. And number 36, the proposal to amend Section 32 of the Tax Appeals Tribunal Act by inserting the following words immediately after the High Court. There. Now, our recommendation, we amend Section 32 of the Tax Appeals Tribunal Act by inserting the following immediately after the words High Court. Inserting the following immediately after the words High Court. Failure to which the decision of the tribunal shall
Let me not say. Hello, Makila.
Thank you, Chairman. Like KRA, if they fail to pay a citizen for refund, there is always timeline for paying. It takes 1 to 3 days. But what about if the person that maybe you overpaid the tax refund, there is no penalty, they delay paying you? Why is it that penalties are in one-way direction? Can you give a suggestion also that if a businessman is being defaulted by KRA and is not being paid money as expected, what is penalty? Because in the spirit of fair trade practices and in the spirit of fairness and administration of justice, then when you penalize this direction, but if you are also being mistreated on this direction, there's also penalties on the other direction, so that there is mutual understanding. What is your threat? What do you think can be done so that there is respect for the contributor and there is also respect for the person who is collecting the money, so that there is fairness in this country? What is your thinking, because you are experts on these particular matters? I think that is my case.
Thank you, Honorable Makilab. I think I got to ask most of the question that I would have asked. But on this insurance services, we were struggling earlier to find out what these services, the insurance services, insurance companies charge, and what percentage of that is it in their business. So that we're looking at this is their input. So what are these services and what percentage? So you see on those ones. Then you know, what I have continuously said is, especially because taxes touch on us individually, we get very concerned, and we take time to prepare our submissions and explain them and get examples and get comparative analysis. But as you said, I wish we'd do the same on the expenditure side. And show you how we don't do very well there. In your presentation, you note that the budget for 24-25 is 4.2 trillion shillings, which is not the case. The 4.2 trillion shillings was what was in the BPS, but that has since been revised. So the estimates that were tabled at Parliament, the National Assembly a few weeks ago, the budget is actually 3.96 trillion. So there are really around 260 billion shillings that has been taken off of budget already. So you know that's why maybe we don't take much keen interest on the expenditure side as we take. I'm sure you not get any of the you did not misquote any of the levies or any of the taxes, but the number for the budget you got it wrong. And I'm wondering if you have made such a candid presentation to the budget committee as well, when they are doing their public participation and estimates. Over to you, Chair.
Thank you. Before you, yeah, there's a list. I think it came from you. I'm just looking at it. This list came from ISPAC?
No. No, that's
okay, sorry.
Proceed, Chair.
Because it was a little worrying me.
Thank you, Chair. Thank you very much, honorable members. And thank you very much for the compliments and the questions seeking clarification. I'll start with the Chair first. We know that there was a revision from 4.2 to 3.9. So that's just a typo. We picked the 4.2 from the budget policy statement, and we have looked at it in a different submission. I think this was just a typo. We know that it came down after the budget estimates were brought to the National Assembly to 3.9. We also know that the deficit, the current year after supplementary is 908 billion, which has now reduced in the current budget estimates to around 500. So the figures, we know them, Honorable Chair. And in our submission to the budget committee, such an error cannot occur. So these are just introduction, but nothing like an error. Number two, I would want to give
Did you appear before the budget committee?
We are yet to.
Do you usually?
Yes.
Okay. When? Because I think they're almost finishing their public participation.
We did our submissions already, but we haven't appeared as in.
Is there someone from BPO? Apart from George seems to be more of finance and BPO.
Okay.
When is it the budget committee finishing their submissions? So actually, we finish today. So the budget committee is completing their public participation on the budget today. So you've not made it seems to be more of finance and BPO.
Okay.
When is it the budget committee finishing their submissions? So actually, we finish today. So the budget committee is completing their public participation on the budget today. So you will not be happy.
Okay. Okay, we may cross over, but so our submissions already were received in written, and they are detailed enough to cover all these areas, including free education and bundling the governments and the national governments. And we've seen the mediation committee has sort of sorted that matter. So we are well aligned with the figures. Honorable Chair, I can assure you, with the figures, we are more aligned than even these legal matters, which of course touch us. So, Honorable Chair, allow us to make a quick response to some of the clarifications that have been sought, and I'll give FCPA Robert to run with that area of questions. There are actually 1, 2, 3, and there are sort of 5 questions, which I'll give not honorable as such, FCPA. When you grow up, you'll be honorable. FCPA Robert to run with that very quickly. Clarify, please.
So, Robert, which constituency are you running? So that I leak to my colleague.
Honorable Chair, fortunately, I do not have political ambitions right now from Molo. Yes, so very quickly, starting with your question, Honorable Chair, the question on insurance, the proposal on insurance, actually that it's deleting the current exemption for insurance and insurance services, and now just replacing that with insurance premium. What that means is that, for example, if I run a business and I get a brokerage commission, or I'm a life agent and I get an agency commission, I actually have to charge VAT on that. And that's the problem that this sector will face, because as it is, insurance penetration is about 2.3%. If you now ask our life agents to start charging us VAT, then chances are that not many people will do that. So whereas premium is exempt, everything else along the insurance value chain would be subject to tax. And that's really the key issue that we are saying. And we are saying, let us just exempt the entire insurance ecosystem other than what is currently provided.
So like the actuarial services, the management fees, consultants fees, all those now will be vatable.
Those are already, actually, as it is, they're already vatable. They're actually already excluded. So it's a very subtle proposal, Chair, that is saying, from an insurance perspective, we'll tax everything other than premiums.
So what you're struggling with is, what is this list of everything? You know, so that we look at the implication of that. Morris, you want to weigh in?
Thank you, Chair. I really feel a bit uneasy arguing with this part because I'm a member. But the issue is, Chair, Chair, FCPA, Robert has put it very clearly that most of the insurance services are actually VATable. The only thing that was not VATable then, and we are also proposing that it should not be VATable, is the premiums. So these other services, because as he has mentioned, the issue of the management fee, including even loss assessment, are already VATable. Probably the only fear is the brokerage services. And I think it needs to be made clear that brokerage services is actually the one that is remaining. And I really don't think that that should be a big issue. Yes, 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 yes. It's not expressly there because we also need to ensure that there could be some other services that we may not know, and it is important that they are covered.
So now, which is why I've been asking since yesterday, what are these other services? I was hoping you could tell me it's 1, 2, 3, 4, and so that we're able to see what is the import of vetting them on the insurance sector. So maybe yourself, or if you can talk to your, is the insurance association or something? Or they're coming up with an hate from the insurance themselves. Okay, thank you very much for it. And you're not arguing with them, it's just, it's a good idea giving life to a better idea, and a better idea giving life to the best idea. So if you are afraid, then I should be very, very worried.
Yes. By Honorable Board and investors. And that's data that we can certainly provide as we give this paper. But however, we do take the point around 15% withholding tax is payable on interest to foreigners. The only thing we are saying is that given our current circumstances, the cost of borrowing in Kenya, the government borrowing in Kenya, which squeezes out or crowds out public sector, which makes these foreign options a better one. So that's something that we probably can provide data around the statistics. On the issue of public benefits and the public sector, Honorable Chair, you know, last year when we appeared before you, we made very spirited attempts or proposals that this proposal be dropped last year, and thankfully you did drop it. So we hope that you're also going to drop it this year, because essentially the concern here is public sector employees may end up getting benefits that are not subject to tax, and therefore we're eroding our tax base, these exemptions. That really is a concern. And the other concern here, Chair, is if we do that, then I think we are going for who gave that. People who have paid use assets, it's not taxable. And what are we doing to our tax base? That is a concern. Then, Honorable Makilap, I agree with you. There is actually, if you look at the Tax Procedures Act, there is a provision that allows that permits taxpayers to claim interest from of unpaid refunds. However, the way that provision is worded, it's impossible to trigger it because the commissioner has to confirm. So they'll never confirm that they owe you, so in which you'll never get any interest. And I think really one of the things that we have to do as a country is have a holistic view, Chair, and say, can we have a look at the Public Finance Management Act? Because the challenge for Revenue Authority to pay these refunds is because they don't have the funding. Because the challenge for Revenue Authority to pay these refunds is because they don't have the funding. And that's because all funding goes to the exchequer. So for it to come from the exchequer, it needs approval. But we're saying if the Public Finance Management Act, I think it's Section 15, can be amended to permit Revenue Authority to retain a portion of the funds collected to settle refunds, or to allow, prior to 2013, we actually had automatic set-offs. So if I had an overpayment, then Revenue Authority can come and audit me 1 year, 2 years down the line. In the event that I have underpaid, I'm happy to pay the penalties. And I really think to support businesses, this is something that we need to bring back so that it's very clear that cash flow is not constrained for businesses, because that is really the problem. And we thank you for the proposal to defer the income for public supplies. And I think this is the steps that we need to take as a country to support businesses. Chair, I don't know whether there's a motivation for paying taxes. Yes, friendly tax collection mechanisms. You know, they tell us that my good friend Maurice Oredia says that they're not in the business of laughing with taxpayers. If they laugh, nobody will pay. So I honestly speaking, Honorable Makilap, if we can demonstrate the public benefit that we are getting from paying these taxes, so that I don't have to pay school fees, I don't have to go to pay medical costs. If we can demonstrate that, I don't believe Kenyans have a problem with paying taxes. However, as it is, we didn't discuss this, Chair, but if you look at this eco-levy, we are taxing the batteries, we are taxing the tires, we are taxing the motor vehicle. The next thing we'll do is that we'll have heart tax as well. I think we just take a break from raising these revenues, and I agree with you. Reduce our budget, and then whatever we are collecting, let us it properly so that taxpayers can actually see the benefit, and that way we won't have Revenue Authority chasing all of us to try and pay the taxes.
Thank you.
Conclude, Chair.
So thank you very much, Chair of the committee, the Honorable Kuria, and honorable members. Thank you very much, my team from ISPAC. On tax motivation and why we should pay, Honorable Chair, it has reached a point where, especially the salaried, now you've raided them completely, introducing even the motor vehicle and where they have to go and pay their premiums from the little that has remained. And the joke out there, Honorable Chair, is that just pick all, take the salary and now pay for me what I have to incur. If I want to eat, let the government pay. If I have to take my kid to school, I come. Because now if you have been taxed to a level where now even the Employment Act of a third rule does not apply, then what do you have? And the same now you follow it, of course, with VAT in the shops and everywhere. So the joke is, if I'm earning 100,000, let me give it to Honorable Kimani. Then when I want to take my kid to a private school, I come.
Why are you giving it to me? Give it to Ken.
Yeah, but we take note of your concerns and questions and compliments and clarifications, and we shall harmonize our document and submit to your team the right time. But we also take note of our participation in the Budget Appropriation Committee, and we shall endeavor to follow up on this, because we submit, but we rarely get to appear like we do appear before this committee and other committees of Parliament. So thank you very much. We appreciate the time we've been given as an institute to make our submission to this committee, and pray it is serious public participation, Honorable Chair. Thank you.
Thank you very much, my Chair. And
I needed to make a disclosure that CPO Ray is a member of the Public Finance and Committee, Tax Committee of ISPAC, but when he's here, this submission he has not participated because of conflict of interest, but he's our member and a member of PFT. Okay. Thank you.
It's really, thank you. I honestly really thoroughly enjoy the conversations that you have with ISPAC. You take you're giving us alternative. What is an alternative and justification? And even you go out of your way, and and like our friends in Deloitte and PwC, where they have take your views as being very, very balanced. And last financial year, this committee has been accused of saying is the public participation and access and utility. And I think you should be one of the people who should be going out there and saying, like, we actually feel there were very many recommendations that you brought, that we took along. You explained to this committee the difference between when you exempt the why going on than it being on exempt. And we made a lot of changes that some people were saying that they saw the impact of that in the business and the economy. And some of those proposals, including this advantage to civil servants that would otherwise accrue benefits to us, because the proposal now to exempt that benefit that we're given on a car, notwithstanding that the car is actually used, I think mostly to target public servants, and by and large, members will not take, even when that amendment would have been. We endeavor to make public participation not just an exercise. We just pick one or two items and make us about the 2 or 3 items. And I'm very happy and that we have bread and motor vehicle. There are so many other, some of those very good proposals, some of them during our report. So let's not make this about just 1 or 2 items. Let us holistically and critically critique the document, and where possible come up with better recommendations so that we come up with a good law. I thank you very much, and we had a very good engagement the other day at your seminar. You like putting me on the hot seat, but it's okay. I can take the heat. Asanteni sana, and wish you all the best. That's up to you. You convince him to take CPA exams. Deloitte, how long do you need for your presentation? 1 hour. I thought you were in the ISPA committee, so that will take. Okay, go on. Maybe make it 30. Make it 30, and then please bring both institute, the Institute of Economic Affairs and Public Finance Institute, so that they're listening. Deloitte and Touche. We have Institute of Economic Affairs, and we have Public Finance, Institute of Public Finance. So I've asked that you all sit in so that matters that have been canvassed, then you do not have to belabor on them in your presentation. And over to you, and then you can take a quick round of introduction. So when it's your turn, then we just go on to your submissions. And then, we did ask that you give us the written submission particular format. So if you could kindly share them with us, so that we can also be going through them. CPA Kimogo, your turn. Introduce yourself, and then over the mic to everyone.
Sorry. Good afternoon, Chair. Good afternoon, members. So my name is Fred Kimodo from Deloitte East Africa. I have my colleagues from Deloitte. I'll allow them to introduce themselves. Thank you.
Yeah, Chair and members, I'm Patrick Chege from Deloitte.
Chair and honorable members, I'm Lucy Kereka from Deloitte.
Chair and honorable member, I'm Esther Muteti from Deloitte.
Chair and honorable members, I'm Emmanuel from SC Johnson.
Good afternoon, Chair and honorable members. Kennedy Okoye from Deloitte East Africa.
All right, Kwame, introduce yourself and your team.
Good morning. Good afternoon. My name is Kwame Wino from the Institute of Economic Affairs.
Good morning. My name is Julie Washira from the Institute of Economic Affairs.
I know it's supposed to meet in the morning, but it is way past midday.
Chair and honorable members, my name is Rafael Muya from Institute of Economic Affairs.
So Public Finance Institute, the idea. No, so introduce yourself, sir. Go on.
Chair, my name is Edwin Wanjao from Deloitte.
Good afternoon. My name is Veronica Ndego, Institute of Public Finance.
Good afternoon. My name is Daniel Murakaru from the Institute of Public Finance.
Okay, over to you, Mother from Deloitte.
Yeah, thank you. We have 3 sets of submissions. 2 of them are very, very brief, Chair. So with your permission, we'll start with the submissions from SC Johnson. It's basically 1 submission. We'll then go to the submissions from Deloitte East Africa, which we are doing on behalf of most of our clients and the taxpayers. And then we'll do submissions for DFSAC, or Digital Financial Services Association of Kenya. So with your permission, I'll give the microphone to Emmanuel, who is the country manager of SCJ, just to give us a brief background of the proposal that we are seeking to have amended in the finance bill. And then Kennedy Okoye will take us through the very specific provision. Over to Emmanuel, through you, Chair.
All right. Thank you, Chair.
Hold on. Do you have the written submission for
SC Johnson?
SC Johnson.
All right. So in brief, SC Johnson is a global company that is leading in pest control. But in Kenya, and in line with the request that we've come today, we are in a journey to try and fight malaria, which is in line with the government of Kenya malaria strategy vector control intervention. We are investing over $10 million, which is close to 1.5 billion, in expanding our facility in Kenya. And the reason for the expansion is to produce low-cost repellents that will be provided to low-income communities for free. And the reason for this is one of the big goals for SC Johnson, which we have aligned together with the Ministry of Health, is to try and contribute in combating malaria. The low-cost repellents will reduce disease transmission, get them through the public health channels to help us protect more families, and there's no profit that's going to be made out of this investment through SC Johnson. All of it is not for profit, is only to contribute to the initiative to fight malaria. And what we are requesting is for the purchase of the equipment that is going to be used to produce these low-cost repellents, is we need the VAT on them to be excluded. But the team from Deloitte will expound more on this.
Yeah, thank you, Chair. As mentioned by Emmanuel, and SCJ expresses its gratitude with the government efforts to try and help it produce these low-cost repellents. Specifically, the government has proposed the introduction of paragraph 148 of Part 1 of the first schedule of the VAT Act to exempt and raw materials used in the manufacture of mosquito repellent upon recommendation by the Cabinet Secretary responsible for health. So what SC Johnson is requesting is just a little expansion of that paragraph to include machinery, such that when this machinery that will go towards expansion of the high-speed lines for manufacture of these mosquito repellents come in, they do not suffer VAT, because if they have to pay VAT, that will squeeze the liquidity available for this expansion, and in turn reduce the capacity and the number of the repellents that will be issued. One thing that Emmanuel mentioned is SC Johnson. They do not suffer VAT, because if they have to pay VAT, that will squeeze the liquidity available for this expansion, and in turn reduce the capacity and the number of the repellents that will be issued. One thing that Emmanuel mentioned is SC Johnson on preventing the transmission and contraction of malaria. We do appreciate the government has already put in place measures to provide relief in terms of taxes on the drugs with anti-malarial active ingredients, which then are used to treat malaria. SC Johnson wants to come in earlier to prevent, because it realizes is to expand that to read inputs, machinery, and raw materials used in the manufacture of mosquito repellent on recommendation by the Cabinet Secretary for matters relating to health. Thank you.
Thank you, Chair. Those are submissions from SCJ. With your permission, we can move to the next set of submissions, Chair. Unless there is any question from the honourable members. Wait, so you have a quick interjection?
Is it already? It's already existing in the bill, and your request is to, in addition to inputs and raw materials, you need to add machinery. Is it in the bill or in the act?
It is in the bill.
Okay. Honourable members, page 571, clause 148 of the bill. It says, by inserting a new paragraph immediately after paragraph 147, 148, inputs and raw materials used in the manufacture of mosquito repellent on recommendation by the CS responsible for matters relating to health. So it is saying inputs, so they want to add input, comma, machinery, and raw materials. The addition of machinery. Okay, proceed. And I think that you have made your case, so Next presentation.
Thank you, Chair. You'll allow Emmanuel to leave if that is okay with you.
You leave at your pleasure. You know, our parliamentary sittings are open to the public, so I may not ask them to leave. They can leave at their own pleasure.
Right, thank you, Chair.
Karibu, all the best.
Thank you, Chair. We move swiftly to the next set of submissions from Deloitte East Africa. We will start with our submissions from an income tax perspective, which will be taken through by Patrick Chege.
Thank you. Chair, under income tax, we have very few proposals, and I'll go straight to the first proposal. Is to clause 9, the introduction of motor vehicle tax. Chair, I know you have had a lot on this issue, and therefore I'm not going to rehearse a lot. I'm just going to mention the areas that I wish there to be some kind of changes. One, the bill proposes at a rate of 2.5% of the value of a motor vehicle, subject to a maximum of 5,000 shilling and a minimum of 5,000 shilling and a maximum of 100,000 shilling. So the other aspect is the corrector will be the insurance companies, and more importantly, an insurance company for what's in the correction will be subject to 50% penalty. So I'm only going to touch on the two areas. Now our proposal is the reduction of the rate from 2.5% to 0.5%. Yeah, so that's our first proposal. Our second one touches on the floor amount. So we are proposing that the minimum tax that should be levied on one particular motor vehicle, the minimum should be 1,000 shilling at a maximum of 20,000 shilling. So we feel this penalty is too punitive, too high, and because this provision has been brought through the income tax, we are proposing that the penalty should be aligned with those penalties provided for under Section 83, Capital A of the Tax Procedure Act 2015. That's the 5%. In terms of justification, I'll just state 3-4 points. Number one, taxing motor vehicle, first of all, is not even a good idea. But if it has to be there, it's important to recognize the fact that upon importation of a motor vehicle, extra duty was paid on the value of motor vehicle, VAT was paid, IDF was paid, RDL was paid, and import duties were paid. All these were paid. And basically, most of these vehicles are not even commercial vehicles, they are personal vehicles, and therefore it's important to take into account that all these taxes have been paid, and levying 2.5% of tax will be too punitive for the owners of motor vehicles. Maybe the other alternative to that submission, Chair, is maybe this committee to consider possibly imposing just a 2 shilling road maintenance levy in fuel instead of going for a particular charge per motor vehicle. Just increase the road maintenance levy by 2 shilling and forget about this tax. That way, we will to collect this tax in a very, very efficient manner, and it's likely to yield more without much litigation from in a quarter, and not even affecting some of the sectors like the insurance, which we expect it to be impacted for, adversely. So that's the first one. The second one, Chair, is at clause number 5, I've decided to skip clause number 23, clause 5, and this is the introduction of withholding tax on supply of goods to government. So the bill proposes that whatever payments that will be made for goods supplied to government, those payments should be deemed to be income of the person doing the supply for that year of income, when the payment is received, and there's no problem with that. The problem comes when a 3% withholding tax is imposed on the resident person and 5% on a net person. So what we feel is that this is a high, and we are proposing a reduction to 1% for resident persons and 2% for non-resident persons. And the reason why we are proposing this, honorable members, is because, number one, if you look at most, they are always complaining of late settlement of their money, their dues. And because of that, they incur a lot of interest. So that interest goes to eat the margins. So most of the suppliers to government are faced with very, very small margins. That's number one. Number two, already these are people who are in the radar of KRA, and given that withholding tax is not final tax, they will still be able to pay additional tax when they are filing the return, in case they make a margin beyond 1% and 2%. So in terms of cash flow, that will help them. So we feel that a 1% and 2% for resident and resident persons should be sufficient. Our submission number 3 is on clause number 23C and 25B3 capital A, and this taxation of government infrastructure. Our submission is that they should be done away with, so that to invest in this sector.
Sorry, where are we?
We are at page 4, item 4. Page 4. Item 4. I was discussing clause number 23C and 25B.
So on clause 23C and 25B.
Yes.
Okay.
Yeah. So in the alternative, then what we are saying, if this tax must remain, then for the resident person, the 5% should be made a final tax, such that there should be no further taxation. We go to page 5, and it's item 5, which is clause 25B3C. And here, the bill proposes to scrap the 24,000 withholding tax threshold, which is applied on management or professional fee or training fee. Now, Chair, the issue with this issue is that thresholds are set so that you don't operate tax on a transaction that's not economical. And if you recall here, when the national tax policy was being presented, there was a clause in one of the pages that talked about the principle of the de minimis non curat rex. It is there in the tax policy, and the commissioner should. So when you place a threshold of 24,000, which is in aggregate, per month, it's a very, very small pay, because this could be 3-4 payments. If you take, for instance, 24,000 and apply a rate of 3%, because these payments would be subject to either 3% or 5%. So you take 3% of 24,000, is only 700 shilling and 720 shilling. If you take a rate of 5%, it's 1,200. So if you look at those two amounts of tax and the administration cost of maintaining those accounts, the administration cost could even be higher than that. So, and therefore, scrapping this kind of a limit is likely to run us into a situation where the cost of learning tax is more than the tax yield itself. So we go to clause 8, same page. This is the digital service tax, which is to be replaced by significant economic presence tax. Chair, here, what the bill proposes is an application of 30% the tax rate on an assumed or deemed 20% profit based on gross turnover. What's the issue here? The issue here is that if you apply 30% on an assumed profit of 20%, is like applying a 6% withholding tax rate on the gross amount. That share is too high, considering that this same or similar tax was there before at 1.5%. We propose that this rate could be brought down from 30% to 5%. To 5%, so that the effective tax rate now becomes 1.5%. So if you take 5%, you multiply by 30%, you get a 1.5% effective withholding tax rate. So that is what we are proposing. And the second proposal in relation to this is you realize that significant economic presence is not to be very difficult for even taxpayers to comply with this. Because if you are just allowing me, these are normal taxes on non-resident persons. Persons who are not registered in Kenya, they have their registration in another country. When they have some significant presence, they become what we call PEs, permanent establishments or branches. And they are taxed at a very elaborate system of taxation exists under the Income Tax Act. Now, we are talking about those who cannot qualify to be permanent establishments in Kenya, but have some sort of presence. So that presence is not defined, and it requires to be defined. So what we are proposing is to have that defined in terms of the size of the transaction. So what we are saying is that we should have a threshold of at least 10 million. So that then you'll be said to have had a significant economic presence in the country. So other than that, it's going to be very, very difficult even for taxpayers to comply. Now we go to...
So maybe what will be your proposal to further define significant tax presence? Would you propose a threshold like you have on VAT?
Yeah, if you look at the same submission, we have proposed a revenue, annual revenue of at least 10 million. Yeah. 10 is a figure we can work with, and that can always be revised based on in a further evaluation. Yeah, Chair, now we go to personal income tax, and my colleague Lucy will take you through.
Thank you, Mr. Chair and honorable members. I will be covering the personal taxes section. We are on point number 7. Clause 6B, subsection 2 of the Finance Bill proposes reimbursement on expenditure incurred by public officers on official duties. So what the bill seeks to propose is that these amounts be exempt for expenditure incurred for the purpose of performing official duties, notwithstanding the ownership or control of these assets that have been purchased. So our recommendation on this is, 1, we recommend that this clause is deleted in its entirety. And it's not feasible. We recommend a deletion of the words, notwithstanding the ownership or control of the assets purchased, and the insertion of, provided that any assets so purchased and control of the public entity that is making that particular reimbursement. And or, I have another or, for purposes of obeying the principle of equity and to ensure that this is not discriminatory, we propose that the amendment should include all employees to read as follows. Any amount paid or granted to an employee to reimburse an expenditure incurred for the purpose of performing official duties, provided that any assets so purchased shall be under the control and ownership of the employer. Our justification of this is with regards to the, irrespective of who owns or controls the assets that have been purchased, we will be creating avenues or opportunities of public funds being misused through the purchase of private assets for individuals. Further, our recommendation of this will remedy this by ensuring any assets that have been purchased with such reimbursements are transferred to either the public body, and in the event our second proposal is taken into consideration, the employer that grants that particular reimbursement. We will move on to the next point, which is under clause 6, section A, subsection 1, which is on the increase on the non-taxable limit of the per diem allowance. The bill seeks to make amendments to section 5(2)(a) P of the Income Tax Act by increasing the non-taxable limit of amounts that have been received by an employee, entertainment or other allowance in respect of a period spent outside an employee's usual workplace. So what the bill seeks to do is to increase that figure from the current 2,000, which is provided for again under section 5(2)(a) subsection 2, to 5% of the monthly gross earnings of the employee per day, where the employer has a policy on payment and accounting of these allowances. Mr. Chair, our recommendation of this, in addition to what the bill has provided for, is that we recommend an insertion of the following provision after the word profits in the Income Tax Act to read, where the employer has no policy, this should be capped at the higher of 5,000 Kenyan shillings per day, or 5% of the monthly gross earnings of the employee.
Okay. Lucy, try to speak a little away from your mic like that. Yes.
Okay.
Proceed.
Okay, thank you. Do you want me to go again? All right. So, okay, I'll go back to what the bill proposes. So the bill proposes to increase that figure from 2,000 shillings per day to 5% of the monthly gross earnings of the employee per day. So our recommendation, in addition to what the bill has provided for, is that where an employer has no policy, this should then be capped to a higher of 5,000 shillings per day, or the 5% of the monthly gross earnings of the employees. And our justification of this is that the current proposal will negatively impact employees who earn less than 40,000 Kenya shillings per month, because the 5% of the gross earnings is even going to be lower than the 2,000 that is provided for currently in the Income Tax Act. Further to that, the tax-exempt threshold of 2,000 Kenya shillings per day has been effective since the National Treasury should actually consider running a periodic review of this to factor in costs that are to do with inflation. So I think that brings my submissions to an end on personal tax. Okay.
Yeah, thank you, Chair. So with regards to VAT, I understand most of our proposals have been canvassed. So I'll try to be quick. And Chair, the first proposal there is quite welcome, the inclusion of the time of supply for exported goods. So our submission is to make it very clear to avoid any, room for dispute with the tax authority, and define that the time of supply for exported goods shall be the time when the registered person is in possession of a certificate of export or exit notes and road manifests in the case of goods exported to the East African Community member states. So that will make it clear and avoid any disputes with the KRA. The second provision, it's on financial services. No need to stress it further. The proposal is to drop this suggestion of bringing these financial services to VAT for two simple reasons. Number one, it's likely to create disputes because the provisions that are already these financial services can be grouped under paragraph 1, part A and B of the first schedule, part 2 of the VAT Act. So deleting this will most likely create that dispute. And to be honest, financial services are already subject to excise duty at 15%. The understanding when excise duty was being introduced is because VAT was not levied on these financial services. There's even a proposal to revise this excise duty rate from 15% to 20%. So levying additional 16% on them will basically take the transactional taxes on financial services to give or take 39%. The next proposal which we are making, it's something, Chair, which you are very well aware about bread. Our proposal is to retain it at zero rating, with a modification that all types of breads are zero rated to at least maintain the cost if, the suppliers don't raise the cost because of other economic factors. Chair, of interest there is another proposal, item 13 of page 12, the VAT treatment of inbound international sea freight services. So this proposal was passed into law via the finance, which zero rated it. And what informed that particular provision being introduced was the dispute and very bizarre scenario that was witnessed between the KRA and taxpayers. How these inbound international sea freight services work is when you import your car, Chair, when it lands at the coast of Mombasa, when you are paying customs duties on that particular vehicle or any good, the freight service is included as part of the taxable value of this particular vehicle, this particular good. Now, if the freighter is a resident person, KRA goes ahead to this freighter and tells them, for that freight service, for the goods you brought and docked at the coast of Mombasa, we want VAT. So it was a scenario where the freighter is forced to issue two invoices. One, for valuation of custom purposes, for which customs duties, including import VAT, is paid. And two, a separate invoice to the same person for freight service only. So this one disadvantages the resident freighters, the cargo consolidators, really puts them out of the business, because definitely using them will be more expensive. They'll be issuing two invoices for the same freight to an importer. So then the resident customers will opt to use non-residents, who then will not issue with those two invoices. So our recommendation is to retain it under zero rating, as it was introduced last year. And if that is not feasible, to qualify Section 14(1) of the VAT Act so as to read, provide the registered person in Kenya shall not be taxed on the supplier, but shall be added to the customs value of the imported goods and taxed as a duty of customs on the importer, which is already happening. Chair, I'll go to input tax deduction, and this specifically speaks to the restriction of input tax to be claimed on passenger motor vehicle, repair and maintenance thereof. Increasingly, we see farmers, tea farms, other farms that are very far away from residential places, do ferry their employees to and from the farm. The VAT Act currently prohibits them from claiming that input tax, whether they buy buses to ferry their employees from estates, residential estates, to the farms, to and fro, which is making them, the cost of doing business being high. So our recommendation is to at least allow such particular organizations, whether they are mines, which are located very far away from where people live, whether they are farms, flower farms, at least allow them to claim input tax when they purchase these buses or whatever modes of transport they're using to transport, their workers to and fro, and the repair and maintenance thereof. Chair, another one also relates to input tax deduction, which is very good idea. Currently, the law prevents people from claiming input tax unless the supplier or the seller has declared that invoice. A very good idea, which we support. The challenge is with the implementation of teams, which will give, as declared, is not functioning as intended. It has some hiccups here and there. So our proposal is to at least allow buyers to claim input tax, provided they have requisite documentation, until such time these teams or e-teams will have been modified and is working as intended, then you can limit claiming input tax to when the seller has declared that particular input tax. I'll pause there and hand it to Esther, who will take us through it.
Thank you, Mr. Chair and the honorable members. I'll be submitting 4 items under the Excise Duty Act. So item 17, which pertains to clause 9, that calls for the repeal of relief of excise duty on raw materials. So currently, section 14 of the Excise Duty Act provides where excise duty has been paid in respect of excisable goods imported into or manufactured in Kenya by a licensed manufacturer and have been used as raw materials in the manufacture of other excisable goods. The excise duty paid on the raw materials shall be offset against the excise duty payable on the finished goods. So this particular provision directly impacts on manufacturers who use excisable raw materials to produce excisable finished goods. So the impact on these will be towards its introduction, where when I bring a particular product or when I use it in my operations, I don't have to pay excise duty, or when I pay, I'm allowed to. So the removal of these means these costs has to be absorbed by someone. Number one, either by the manufacturer, or it's going to be transferred to the eventual user. Already, most of these goods that are affected attract high excise duty. So our proposal will be to delete these in its entirety. And also, when you look at section 14.2, it also provides for where excise duty has been paid in respect of internet data services by a licensed person who purchases the data in bulk for resale, then the excise duty paid shall be offset against the excise duty payable by that person on internet data services supplied to the final consumer. So for bulk sellers of data, they're going to be directly impacted. And our proposal is we still retain section 14 for the manufacturers and bulk sellers of internet to continue enjoying that provision where they're allowed to offset. Another proposal that we still have under these items, so where we are recommending section 14.1 to be amended by inserting the words. So the raw materials which actually enjoy the offset, we are proposing insertion of the words and packaging material immediately. This is because a number of excisable packaging materials are used by these same manufacturers, and it has not been very clear whether they should be enjoying this relief or not, and it's been interpreted differently by different parties. So we want that clarity, and that's why we are making this submission for consideration that the packaging material should be included under this section. So the second item is the introduction of excise duty on vegetable oils of very specific tariff headings. These are touch on palm oil, sunflower oil. And how we are looking at it is that vegetable is a basic commodity in almost every Kenyan household. And the push towards this, or rather why we've seen an increment in its usage, is because of its low or almost non-existent cholesterol levels. I think as a country, we don't want to go back to an era where every medical case is associated with cholesterol. So 25% increment, and this is ad valorem rate. So ad valorem is simply 25% of the value that we are currently paying. So we are bound to see increment at 25%. And it's barely a year where factors outside our control, where we saw a shift of this price. I think this proposal is seeking to add another 25%. So we will be proposing on its removal, because if it's too high for a Mwananchi to afford this, then they'll definitely shift to other means, which again will be dealing with issues of cholesterol from a medical perspective. Then again, vegetable oils are also a raw material on some of the basic household commodities like soap. They are still the same items that are used. Bread, which as discussed earlier, is also getting a hit in this bill. So we are seeking to delete it entirely for people to continue enjoying their vegetable oils and their bread in the morning. Then there are two proposals that we are seeking. They are not in the finance bill, but we thought it's important to discuss them. So I'll brush them very fast. So the first one is the first schedule of the Excise Duty Act provides for excise duty on imported glass bottles. So the only exclusion is imported glass bottles for packaging of pharmaceutical products, provided that it shall not apply to glass bottles imported from any of the countries within EAC community. The current rate is at 35%, whereas this was a good move initially. The current market does not have enough capacity to produce glass bottles. At the moment, we understand it's only, and most of the glass we are getting actually outside EAC, which has resulted to increased costs of the excisable goods or any other good that is packaged by glass bottles. Given that we are very key to shift to packaging materials that are very environmental friendly, and glass happens to be one of them, and at the moment the plastic packaging is at 10%. So you can imagine where plastic packaging, if I bring it, it's a 10% excise duty, but for glass it's a 35% where we don't have current capacity in Kenya. Then the question remains in terms of the climate action where we are headed. So our proposal is to kindly consider to amend where we'll be having even glass that is coming outside EAC not being subject to this duty of 35%. The last one is an issue around excise stamps. Regulation 14 of the excise duty, excisable goods management system regulations of 2017, they provide as follows. Under 1, and this is purely on issues of damaged excise stamps shall be preserved for verification by an authorized officer, and where manufacturer or importer of excisable goods cannot account for any excise stamps issued to him by the commissioner shall compute the excise duty and other taxes on the unaccounted for stamps based on the highest excise rate, value and volume of excisable goods manufactured or imported by the manufacturer or importer as the case may be. So on the third regulation 14.3, in computing excise duty in the case of unaccounted for excise stamps, the commissioner shall allow for wastage and damages which shall not exceed 1% of the quantity of the issued stamps. So the issue here is when you look at regulation 14.1, there is that requirement where during your operations you have damaged stamps, you're supposed to keep them aside for verification by another authorized officer. But when you come down under 14.3, where assuming they got lost or anything happened to them, you are only allowed 1%. So what happens in this case, where the ones that you are able to account, whatever you are able to show the commissioner is way beyond the 1%, does it mean you still pay excise duty on stamps that you are able to, stamps that are able to be presented to the commissioner for verification? So we are proposing insertion immediately after 14.3 that reads, provided that a manufacturer shall be deemed to have accounted for damaged stamps verified by...
Hold on. So this new proposal is an amendment to the regulations.
Yes.
Even though they are good proposals, but then they cannot be done on the finance bill. Because these are regulations. So, and regulations go to the committee on delegated legislation. So the best we can do is recommend to on our report or to KRA to institute this with National Treasury to cause this amendment to the regulations. Okay. But it's not possible you cannot amend regulation.
Okay. That is well noted. Thank you.
Thank you, Chair. We are drawing closer to the end of the submissions by Deloitte. We are getting now to the tax administration. I'll present on 3 of the issues. My colleague will take 2 of the other issues. Then we'll be done. Now, I'm on page number 21, issue number 22. The clause is clause number 53. And I think this one, Chair, has been deliberated by the other group that was here. It is a proposal that is seeking to delete section 42, subsection 14E, which is basically then, if deleted, it is going to empower the commissioner to issue agency notices in instances where the taxpayer has not exhausted its channels to appeal against an unfavorable decision. And I think it has been canvassed by the other group, but it is worth noting that from where we sit, if Chair and honorable members, you can remember a provision that was proposed last year, where taxpayers were actually required to pay 50% of the amount of tax that is payable before appealing at the High Court. We think that if this proposal is actually passed as it is actually passing that proposal using the back route. And it can even be very, very bad, because the commissioner can even correct 100% of the tax that has been lured against the taxpayer. So the proposal is to retain the provision of ensuring that we tighten our laws. We are also recommending a slight addition to the provision that we have. And the proviso that we are recommending to have is that the taxpayer has not appealed against an assessment specified in a decision of the tribunal or the court in accordance with the timelines provided for under section 53 and 54 of the Tax Procedures Act. What that does is to ensure that even from an revenue authority perspective, you're also not left overly exposed. We cap this to 30 days. If you don't appeal to the High Court within 30 days, then the Commissioner has the right to go for you and issue the agency notices. So, Chair, we request that this proposal is actually deleted from the Finance Bill. Allow me not to go through the proposed amendment under clause 53. I think it's self-explanatory. It's just an issue of trying to reduce the period within which an agency notice will remain valid from 1 year. Our proposal is to make it 6 months. Now, on clause number 56, Chair, and I think also it was canvassed quite in a bit of detail, but just for the sake of the honorable members as well. So what this proposal is seeking to do is to say, if the commissioner requests for information and you do not provide, probably, for example, provide 90% of that information and 10% is not provided, the whole of that objection is deemed to be invalid, which is huge, because what then that means is that someone from the revenue authority may just decide to abuse this particular provision and ensure that they actually never issue objection decisions. So that's what we are against, and we are requesting that that provision is not introduced through the Finance Bill. And just to apply an assessment today, you have 30 days to do what we call a notice of objection. When you do a notice of objection, the commissioner has 14 days to come back to you and tell you, look, I've looked at your notice of objection, but I need information 1, 2, 3, 4 to be added. And the commissioner actually is supposed to give you 7 days under the law. So what this provision is now trying to introduce is that if you don't provide that information within 7 days, that your objection is deemed to have been invalid. Now, it raises even the question of, at what point do you even take yourself to the tribunal? Remember, you don't have any decision. So it is left to you to interpret whether it was actually deemed, because there is no communication. And that is why we are requesting or recommending that even if the objection is to be disallowed, there needs to be communication in writing from the commissioner specifying that I requested for information 1, 2, 3, 4. You only provided 1 and 2. As a result, I'm going to disallow item 3 and 4. And as a result, the taxpayer then will be able to move swiftly to the Tax Appeals Tribunal to seek redress. The other clause, Chair, is on clause number 57, that is basically seeking to integrate e-teams to the data management reporting system provided by the KRA. I think this one has also been discussed. The issue that is here million Kenya shillings penalty per month that is proposed is untenable. It is too high, and any person who is actually able to pay this may not even be able to continue with business. So the request is that you review this penalty downwards to 5% of the transaction value. Remember, the main reason as to why this particular provision is being introduced is to ensure that people do integrate. So we ask ourselves, what is the purpose of integrating? It's because the Revenue Authority want to have visibility of the transactions that these taxpayers have. So then we think that basing the penalty on the invoices that you have generated during that period that you are not integrated illegally, then would be a more reasonable penalty to have, in which case then we recommend that it is the higher of the 5% or 100,000, is the lower of the 5% or the 100,000 Kenya shillings. Sorry, I think it's whichever is higher. So I think that one is worth looking at. And the other thing also to note, the way the penalty is worded at the moment, it almost appears that it is at the discretion of the commissioner to determine whether it is 100,000 or 2 million. It's like a ledge that has been given. So in other words, if those powers land in the hands of the wrong person, then it may mean that there will be a lot of discrimination in terms of on that basis, Chair, we request that that penalty is revised downwards. Allow my colleague to just take us through the 3 remaining issues on tax administration, then we can move to the last set of submissions. Thank you, Chair.
Thank you, Fred. Chair, I drew attention to the waiver of penalties and interest. So through the Finance Act 2023, an amnesty program was introduced, which lapses next month. So our proposal is that the amnesty program should be extended to next year. This will give enough time for the KRA to conclude its audits and also for taxpayers to source enough funds to settle their debts. Further, we also recommend the reintroduction of Section 89, 6 and 8, which was scrapped by the Finance Act 2023. This will introduce a general...
And members, it's important to know that this is a new proposal, not currently in the bill. Proceed.
Thank you, Chair. Yes, this is a new proposal for the reintroduction of Section 89, subsection 7 and 8. This will provide a general provision for the waiver of interest. This will allow the Commissioner to waive penalties and interest, especially where there is undue distress. Thank you, Chair.
Good afternoon, Chair, and honorable members of this committee.
Maybe this one, a quick one. KRA, so far we saw, I think, 620,000 taxpayers get out of blacklisting, if I call it like that, and collection of, I think, 290 billion. So what do you think about the proposal to extend the waiver of penalties and interest?
Thank you, Chair. I want to make a request on this, because the waiver program is still running. Assuming we put an amendment now, then those people who would have wanted to apply for the waiver will not come forth. So I think it's a matter that we can look at and see whether we can have it. Yes. Yes.
The program is already ongoing.
Yes.
That's very good. Proceed.
Thank you for that, Chair. So for purposes of the record, my name is Kimutai Kandie. I'm supporting Deloitte on the final 2 proposals, being proposal number 28 and 29. So for 28, this speaks to a proposal that is not captured within the bill, particularly being in terms of the timelines within which taxpayers may object to an unfavorable assessment. So we have to amend Section 5111 of the Tax Procedures Act to increase the timelines within which the Commissioner should revert to an objection with an objection decision from the current 60 days to 90 days. That more or less becomes a 50% increase in the commissioner's timelines under the law. Now, our proposal on this issue, and in the interest of equity, is to extend a similar increase to taxpayers in terms of their response to an unfavorable objection. So currently, Section 51(2) of the Tax Procedures Act requires taxpayers to issue an objection within 30 days of receipt of an assessment. Our proposal is for that period to be extended from 30 days to 45 days, being a similar 50% increase as has been accorded to the Commissioner. So that's about it from a Tax Procedures Act perspective. Now looking to the final proposal, and this relates to other measures captured under Part 7 of the bill. Here we are speaking to Clause 63, that through which the bill seeks to amend Section 51 of the Data Protection Act 2019 to exempt the Commissioner, or to exempt the processing of personal data from the provisions of the such processing of personal data is purposed at, or rather is being performed
Sit back, relax, and shika a world of hit TV shows and movies with Showmax. Including a host of new Kenyan shows this year, streaming for Africa. Sign up on showmax.com.